Gold doesn't usually move like this. 82 an ounce to watching roughly $900 evaporate as if it had never existed. Silver didn't just fall, it folded. 64, it slid into the mid-70s, a drop on the order of 37%, the kind of number that normally belongs to small-cap stocks, not monetary metals. And the speed is the part that should make you pause. Not months, not weeks. They said this could never happen in a market this deep. They said gold was the calm corner of the storm. Then the storm found it anyway. Here's the uncomfortable truth. The metal didn't change. The plumbing did, because the most important story in markets is rarely the headline price. It's who is forced to act, when, and under what rules. And in this episode, the rules changed right in the middle of the mania. The institutions already understood what that meant. Most people didn't, because the mechanics are invisible until the moment they become violent. What I'm about to walk through isn't opinion. It's a pattern. It's how parabolic moves break, how leverage turns into a trap, and how this is the bottom can be both true and dangerously wrong at the same time, depending on the time horizon and the mechanism driving the sell-off. Welcome to Meridian Ledger, where we translate market plumbing into plain English before it becomes consensus. If you come here, it's because you'd rather understand the structure than chase the noise. If that sounds like the wise elder you'd like in your feed, you already know what to do. And tell me where you're watching from, because markets are global, but the way they hit people is always local. Now let's rewind carefully and look at what actually happened. 82, 64. Those numbers weren't just highs, they were signals of an overheated system. When prices go vertical, they don't rise smoothly. They rise by pulling demand forward, by rewarding late entries with instant profit, by attracting the kind of leverage that only exists when everyone believes volatility is someone else's problem. And then, almost on cue, the market delivered the reminder. Over the next days, the metals complex sold off hard. Gold shed on the order of $900 from that peak. 70, with the same kind of relentless red candles that traders usually associate with forced unwinds. Exchange-traded funds that track these metals didn't cushion the fall, they amplified the message. 44, 95. That doesn't happen because every holder suddenly discovers a new fact about geology. It happens because positioning is being forcibly reset, and that collision has a trigger you can measure. The Chicago Mercantile Exchange, through its metals complex, raised margin requirements. For gold, the standard risk performance bond moved from about 6% of contract value to about 8%. For silver, it moved from around 11% to around 15%. Those aren't just small administrative tweaks. They are a direct change in the amount of cash required to hold the exact same exposure. If you hold a leveraged futures position, your position doesn't care about your narrative. It cares about your collateral. Raise the collateral requirement, and you either add cash or reduce the position. If a lot of people are in the same crowded trade, that decision happens at the same time, in the same direction. That's how a market that looked unstoppable becomes a market that feels like it has no floor. This is where the word bottom becomes dangerous, because it gets used as if bottoms are made of confidence. Most bottoms are made of exhaustion. Exhaustion of sellers. Exhaustion of margin calls. Exhaustion of the reflex to hit the bid. In other words, the bottom is a process, not a moment. And we have seen this movie before. In 1980, silver went vertical into a frenzy that ended with a collapse. The details change with every era, but the core is the same. Leverage, concentration, rule changes, liquidation, then a long debate about value versus price. In 2011, silver surged and then dumped hard after margin requirements rose in rapid steps. The price action didn't ask permission. It simply recalculated what was possible when a leveraged crowd had to delever in a hurry. In 2020, the market learned that paper price and physical access can diverge when stress concentrates. Premiums, availability, and delivery timelines started telling a story that the screen price didn't fully capture. The lesson was simple. Markets are not just charts, they are systems. And in 2026, the system flashed again. A parabolic move formed, and then the structure tightened. Margin rose. Volatility rose. Liquidity thinned. The trade that looked easy became expensive to hold. That's the moment when the crowd discovers the difference between wanting to be right and being able to stay in the position long enough to benefit. Now, zoom out and look at the players, because this is where it gets interesting. There's the exchange itself, which doesn't take a view on price, but does take a view on risk. When volatility jumps, the exchange raises margin to protect the clearinghouse and the integrity of settlement. That is rational from their standpoint, and it is brutal from the standpoint of anyone stretched too thin. Then there are the banks and prime brokers whose risk models often tighten at exactly the same time. As volatility spikes, internal limits get hit, financing becomes less friendly, haircuts increase. Suddenly the trade that was fine on Monday is reviewed on Wednesday and reduced by Friday. Then there are the ETF flows which become the public scoreboard. When large funds see redemptions, they may need to sell underlying exposure or adjust hedges. That can add pressure into moments of weakness, even if long-term demand for the metal hasn't changed. And then there is the split in expert commentary, which tells you more than any single forecast. Some desks frame this as a technical deleveraging event, with buyers still highly bid for upside, implying that the structural bid for monetary hedges remains. Others argue the parabolic move broke, and the instinct to declare a bottom is premature. Both can be true because they are talking about different layers of the market, the long-term role of the metal and the short-term positioning in the paper trade. This is not conspiracy. It's coordination through timing, because everyone reacts to the same volatility in the same rulebook, even if nobody makes a phone call. So where is the dislocation? It's between what futures and ETFs are screaming and what the underlying rationale is whispering. On the screen, the paper market says panic. On the ground, the reasons people own metals haven't magically evaporated. Currency hedging doesn't disappear in a week. Institutional asset allocation doesn't flip on a dime. Central bank accumulation, when it exists, does not suddenly reverse because a futures chart got ugly. This is the tension that creates opportunity for those who can think in mechanisms rather than emotion. But it also creates traps for those who confuse a forced liquidation with a permanent change in value. Let me show you the mechanism in plain language. Imagine a crowded theater where everyone is leaning forward to see the stage because the show is spectacular. That's the parabolic phase. Now imagine the building manager announces mid-show that the front rows must stand farther back unless they pay a higher fee. Many people can't, so they shuffle backward at the same time. The movement itself causes jostling, and the jostling causes more people to lose their footing. The show didn't change, the rules of standing there did. That's margin. When gold's requirement goes from 6% to 8%, you have to post a third more collateral to hold the same contract. When silver's requirement goes from 11% to 15%, you're posting more than a third more. For a trader running high leverage, that's not a nuisance. That's a decision point. Add cash, sell something else, or reduce the metal position. If other assets are also volatile, the easiest thing to sell is often the thing that still has liquidity. So the selling becomes self-reinforcing. Price drops trigger more margin stress. Margin stress triggers more selling. More selling widens spreads and thins bids. Thinner bids produce sharper drops. Sharper drops trigger more margin stress. The loop continues until the forced sellers are gone, or until a deeper pocket steps in and absorbs the flow. That is why bottoms formed by deleveraging are aggressive. They snap, they overshoot. They punish both the late bulls and the early bears. They create the impression that the market is broken right before it begins to behave normally again. Now, what does the evidence say beyond the story? It says the move had the signature of collateral pressure. Look at the timing. Record highs, then a swift reversal. Look at the magnitude. Gold down roughly 900 from the peak, silver down about 37%. Look at the policy lever. Margin raised in both gold and silver. Look at the spillover into the most accessible vehicles. Major ETFs showing double-digit to near 30% drops in a short window. Those are not the fingerprints of a slow, thoughtful reassessment. Those are the fingerprints of forced action. So what does that mean going forward? Historically, when an asset sells off because the market's plumbing tightens, the next phase is defined by whether the underlying demand stays present once the leverage is wrung out. If the fundamental bid is real, the market tends to stabilize, then grind, then reclaim levels that seemed impossible during the liquidation. If the bid was mostly leverage and narrative, then the stabilization becomes a plateau that slowly sinks as attention moves on. There are three broad scenarios, and none of them require prediction, only observation. In a conservative path, volatility cools, margins remain elevated, and price chops in a wide range while the market rebuilds depth. You'll see declining intraday swings, steadier volume, and fewer gap moves. That is the market relearning how to trade without adrenaline. In a moderate path, the forced selling exhausts quickly and the market rebounds sharply, not because of a new story, but because the same buyers who missed the run-up see the drawdown as a second chance. In that case, you often see violent up days, followed by hesitations, followed by another push, because confidence returns in bursts, not in a straight line. In an aggressive path, the dislocation between paper selling and underlying demand becomes so large that the rebound is explosive. That usually requires a catalyst that forces shorts to cover or forces liquidity providers to reprice risk fast. It's rarer, but when it happens, it's the market's way of reminding everyone that positioning cuts both ways. So what should be watched if you want to understand which path the market is walking? Watch margin notices and volatility because they tell you whether the system is still tightening or beginning to loosen. Watch the behavior of the most liquid proxies because they reveal whether the public is still dumping exposure or starting to reaccumulate. Watch whether down days are met with immediate bids or with empty air. Watch whether rebounds hold into the close or fade as soon as liquidity thins. These are not predictions. They are indicators of mechanism. And now we arrive at the divide. In every episode like this, there are two groups, not the smart and the dumb, the prepared and the unprepared, the ones who understand that forced selling is a temporary event, and the ones who treat every red candle as a permanent verdict. The wealth gap in markets is often an information gap. Institutions see the collateral change and they adjust early. They don't wait for a viral clip or a trending headline. Retail often reacts to price alone, which means they react last, after the leverage has already unwound and after the best liquidity has already been taken. That's why this bottom, if it is a bottom, feels aggressive. It's not trying to comfort anyone, it's trying to clear the market. The question isn't whether metals have a role in a world of shifting currencies and shifting confidence. The question is whether the paper structure can absorb the crowd without snapping again. To make this clearer, notice why parabolic tops are so often followed by rule changes, even when no one is trying to call a top. Markets are built on the assumption that tomorrow will look enough like yesterday that risk can be priced. Parabolic moves break that assumption. When gold is drifting, a 6% performance bond may cover typical swings. When it's printing record highs and then shedding hundreds of dollars in days, that same bond can become too small too fast for the clearing system to stay comfortable. The exchange doesn't care if the move is bullish or bearish. It cares that contracts can be honored. So the exchange tightens and the tightening becomes the spark that hits the leverage pile. This is why, in past cycles, the trigger often looks like a technical detail. In 2011, silver's run didn't end with a single headline. It ended as margin hikes turned a crowded trade into an expensive one. In 2008, the crisis wasn't only falling prices, it was collateral being repriced across the system. In 2020, it wasn't only fear, it was financing and delivery friction that made certain markets seize. Different years, same anatomy. When collateral becomes scarce or more expensive, the weakest positions are liquidated first, no matter how right the thesis is. And that points to the contradiction at the center of this episode. If you only watch price, it looks like demand disappeared. If you watch structure, it looks like demand collided with a collateral event. Those are not the same thing, and confusing them is how people get whipsawed. Futures are designed to give large exposure with relatively small capital. ETFs are designed to make exposure easy for the public. Both can function smoothly for long stretches, and then they reveal their nature. They are ways to own metal through a system of financing, liquidity, and rules. When that system tightens, even the best narrative can be forced to sell. Now look at institutional behavior through that lens. Some institutions are natural holders. They accumulate slowly, rebalance periodically, and care more about long-term role than day-to-day volatility. Others are natural traders. They provide liquidity, run relative value books, and manage risk tightly. When volatility spikes, traders reduce risk because their mandate is survival. When traders reduce risk, price moves. When price moves, holders get a better or worse entry depending on direction, but they are not the ones setting the tape in the heat of the unwind. So the market becomes dominated by the people who must act, not the people who want to act. It isn't. It's reflecting the most urgent flows, and those flows leave clues. One clue is how price behaves around obvious levels. In a normal correction, price drifts into support, volume fades, and buyers test the waters. In a deleveraging event, price slices through levels everyone has drawn lines around, because the seller doesn't care about a line. The seller cares about meeting a cash requirement by a deadline. Another clue is the shape of intraday moves. In forced selling, you see sudden air pockets, sharp drops, and then sharp rebounds that don't make sense if you think the market is a debate. It's not a debate in that moment, it's an auction under stress. And there's the clue that confuses the most people, experts talking past each other. Both can be true because the market is layered. Short-term positioning can break even while long-term demand stays intact. A blow-off move can end even while a secular theme continues. When you hear contradictory takes, don't ask who is smarter. Ask which time frame and which mechanism they are describing. Now, the dislocation becomes tangible when you compare paper speed to physical friction. Paper markets reprice instantly. Physical markets move slower. Inventory, transport, and delivery schedules matter. When paper collapses quickly, physical behavior doesn't instantly mirror it. Sellers may hesitate to part with metal at the new screen price. Buyers may pause, but only up to the point where industrial and sovereign needs reassert themselves. That mismatch can create a gap between official price and real-world friction, even if the screen is the only thing most people see. Even within paper, different instruments can tell different stories. Futures can be dominated by margin dynamics. ETFs can be dominated by public flows and hedging. Options can be dominated by volatility pricing. When the whole complex breaks together, it's usually because the core constraint is shared: collateral and risk limits. So if we're going to talk about whether this is an aggressive bottom, we need a definition. An aggressive bottom is not one that feels reassuring. It creates maximum discomfort. It shakes out late longs who bought the top. It punishes early shorts who press too hard. It creates enough two-way volatility that anyone without a plan gets emotionally exhausted. It does this until the marginal seller is gone and the marginal buyer becomes confident. The market can absorb flow without snapping again. That's why aggressive bottoms often come with sharp rebounds that fail, followed by another sharp drop that fails, followed by a range that feels endless, followed by a move that looks obvious only in hindsight. So what would suggest the forced phase is ending? You'd see daily ranges begin to compress. You'd see rebounds hold longer instead of fading instantly. You'd see fewer gap moves at illiquid times. You'd see the market absorb size without slipping through multiple levels. And you'd see the conversation get boring because real bottoms are rarely celebrated in real time. They are dismissed until they aren't. There's one more layer behind many metals moves: currency confidence. Gold and silver are not just commodities. They are barometers. When confidence in paper instruments wobbles, the barometer responds. But even when that long-term driver is present, the short-term path can still be dominated by leverage mechanics. The macro doesn't trade minute by minute. The margin clerk does. So keep this mental model. Separate the thesis from the vehicle. A thesis might be that metals hedge monetary disorder. A vehicle might be a leveraged futures position. The thesis can be right while the vehicle gets destroyed. That is not unfair. That is structural. If you want one image to remember, picture a rising tide lifting boats and then a storm hitting the marina. The tide is the long-term driver. The storm is the leverage event. After the storm, the tide can still be rising, but some boats are gone, and the survivors are the ones that were anchored properly. This is why institutions appear to know before the public does. They don't need secret information. They have a better map of the plumbing. They watch margin changes, funding conditions, volatility, and risk limits. By the time a headline says, "sharp drop," risk desks have been acting. And that brings us back to the choice in front of everyone watching. The choice isn't optimism versus pessimism. It's reactive versus analytical. To follow price as a mood or to follow structure as a cause. If this is a bottoming process, it won't feel like a victory lap. It will feel like confusion. That's what happens when a leveraged crowd gets cleared and a longer-term crowd begins to step in. And remember what the chart can't show. The people who survive are rarely the ones who were the loudest at the top. They're the ones who sized risk so a margin change couldn't evict them, who expected volatility, and who waited for the auction to calm before trusting the next move. They treat stress as data, not drama today. And if it isn't a bottom yet, the market will tell you through the same mechanisms: expanding volatility, tightening collateral, and price behavior that refuses to stabilize. You don't have to guess. You have to observe. This is Meridian Ledger, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. And remember, the market doesn't ring a bell at the bottom. It changes the rules, forces the weak hands out, and then moves on as if nothing happened.